Your money-making broadcast starts now. Good evening. Today is June 10th, Wednesday. Here are the top stories moving the markets. We are facing a brutal double whammy as a scorching hot May CPI report collides with escalating tensions in the Middle East, sending the S&P 500 and Nasdaq into a broad sell-off. The stagflation nightmare that investors feared has officially arrived, and we are seeing a violent shift in market sentiment. This is not merely a temporary dip, we are witnessing a fundamental repricing of risk across all asset classes. As inflation proves stickier than the Federal Reserve's most optimistic projections, the gap between market expectations and macroeconomic reality is widening, creating a volatile environment where traditional correlations are breaking down. We will analyze why the current data suggests a deeper correction is underway and how you should position your portfolio to survive this storm. Before we dive into the deep analysis, let's look at the numbers from today's closing bell. It was a sea of red across the board. The S&P 500 closed at 7,266.99, down 1.62%. The Nasdaq took a harder hit, falling 1.98% to close at 25,169.50. The Dow Jones Industrial Average followed suit, dropping 1.87% to 49,918.78. In the ETF world, SPY fell 1.58% to $725.43, breaking below the critical 730 support level, while QQQ dropped 2% to $693.69. The VIX, our fear gauge, surged 11.83% to 22.22, which is now officially above the worst shock levels. In other assets, WTI oil jumped 4.43% to $92.11, while the 10-year Treasury yield remained relatively calm at 4.54%. Gold, surprisingly, saw a liquidation, falling 4.15% as investors scrambled for cash. Bitcoin also felt the pressure of the risk-off mood. If you look at the 5-day trend, the S&P 500 has declined 4.18% from its peak on June 4th. This is a rapid breakdown that demands immediate attention. The speed of this decline suggests that institutional investors are aggressively deleveraging, which often precedes a more prolonged period of volatility. Our first and most critical story today is the CPI shock that has sent ripples of panic through Wall Street. The May 2026 Consumer Price Index came in significantly hotter than anticipated, with headline inflation soaring to its highest level in 3 years. While the market was expecting a reading around 2.8%, estimates suggest it has hit 3.2% or higher. This is not just a minor miss, it is a fundamental shift in the macro narrative. Java's analysis confirms that we have entered a high-risk stagflation scenario where inflation is rising while growth is under pressure. For investors, this means the Federal Reserve's path is now locked in. Any hopes for rate cuts in 2026 have essentially evaporated. The market reaction was immediate and severe, with the S&P 500 dropping 1.62% and the Nasdaq sliding nearly 2%. The most alarming part is the reflexivity cycle now in play. Hot inflation forces the Fed to keep rates high, which slows economic growth, which then increases earnings risk, leading to more selling. This is a negative feedback loop that will be incredibly difficult to break unless we see a dramatic cooling in prices or a pivot in Fed policy, neither of which seems likely in the immediate term. Furthermore, the core CPI, which strips out volatile food and energy prices, showed an unexpected uptick in services inflation, suggesting that wage price spirals may be becoming entrenched in the economy. Adding fuel to the fire is our second big story, the rapid deterioration of the geopolitical situation in the Middle East. Just as the market was hoping for a diplomatic resolution, President Trump has vowed immediate attacks on Iran, effectively shattering the narrative of a near-term ceasefire. This escalation is directly impacting the energy markets. WTI oil surged 4.43% today, closing at $92.11. This creates a dangerous paradox. While oil usually rises during conflict, it is now acting as a reinflationary force. Oil at $92 per barrel will likely feed back into the next CPI report, making inflation even stickier and further trapping the Federal Reserve. From a professional trading perspective, as Paul Tudor Jones often suggests, price action speaks first. The price action today is unambiguous, it is a total risk-off environment. When the VIX surges to 22.22, which is above the level seen during the worst shock, it tells us that the market is no longer buying the dip, it is hedging for a deeper correction. We are seeing a broad-based liquidation where even safe havens like gold are being sold off to cover margins elsewhere. This dash for cash is a classic sign of extreme stress, where liquidity becomes the only priority, and fundamentally strong assets are sold simply because they are liquid. Finally, we must look at the cracks appearing in the AI trade, highlighted by Oracle's disappointing cloud sales. Oracle's miss is a significant sentiment indicator. For months, the market has priced in an aggressive AI infrastructure spend, but if a legacy giant like Oracle is seeing a slowdown in cloud growth, it raises a red flag for the entire sector. We saw this play out in the semiconductor space today, where the correlation between stocks was terrifyingly high. Broadcom fell 5.12%, AMD dropped 4.86%, and Qualcomm plummeted 6.92%. This validates the node transformer thesis. In a high correlation sell-off, these stocks move as one block. The AI trade is no longer a guaranteed win, it is now a high volatility battleground. The market is shifting from a narrative of growth at any cost to a narrative of quality and capital preservation. With the S&P 500 now below the critical 7,300 level and the Nasdaq below 700 for the QQQ ETF, the technical floor is beginning to crumble. We are seeing a rotation away from high multiple growth stocks toward companies with actual earnings and strong balance sheets. The era of cheap money is officially over, and the market is now demanding a rigorous audit of AI monetization. If companies cannot prove that AI is driving bottom-line growth, the valuation multiples will continue to compress violently. Turning to the portfolio side, the Javas managed portfolio at $105,731 demonstrated exactly why 72.4% cash was the correct positioning. The semiconductor-heavy holdings took significant blows. Broadcom fell 5.12%, approaching its $360 stop level. Qualcomm dropped 6.92% and actually breached its $195 stop loss, and AMD declined 4.86%, nearing its $440 stop. Even Nvidia fell 3.73% to $200.42, approaching its $195 stop. The only green position was FFH.TO, which gained 1.22%, proving the value of insurance sector exposure during macro shocks. The key lesson today is that sector concentration amplifies losses. When semiconductors fall, they all fall together. The 51% semiconductor concentration in the portfolio magnified today's drawdown, but the high cash buffer absorbed the impact brilliantly. Total portfolio loss for the day was manageable at roughly 1.2%, which is exactly what proper risk sizing looks like. Looking at the broader macro picture through Ray Dalio's machine framework, we are now firmly in the late-cycle squeeze phase. Inflation is re-accelerating, the Fed cannot cut rates, and growth is decelerating. This is the stagflation quadrant, the worst environment for both stocks and bonds. The reflexivity cycle is now accelerating. Hot CPI forces the Fed to stay tight, which slows growth and increases earnings risk, which drives more selling, which further tightens financial conditions. The Iran escalation adds a dangerous feedback loop where oil at $92.11 becomes reinflationary, making it even harder for the Fed to pivot. The key events to watch tomorrow are the May PPI print at 8:30 a.m. and initial jobless claims. If PPI comes in hot as a follow-up to today's CPI, we could see SPY test the $715 to $720 zone. Cash preservation is the only sensible strategy until either Iran de-escalates or the VIX spikes above 25 to 28, signaling capitulation. To recap today's chaos, we are dealing with a toxic combination of 3-year high inflation and escalating war threats, which has pushed the VIX over 22 and wiped out nearly 4.2% of the S&P 500's gains from its June 4th peak. The only winning move right now is a heavy cash position to preserve capital while we wait for the dust to settle. We must remain vigilant as the intersection of geopolitical instability and macroeconomic failure creates a perfect storm for equity markets. Looking at the opportunities amidst the carnage, here are 4 strategic picks. First, for the safe-type investor, the legendary global value investor John Templeton would choose Verizon, VZ, at $42.30, viewing it as a classic defensive dividend play in a stagflationary environment with predictable cash flows and low beta. Such assets provide a psychological and financial cushion when the broader market is in freefall. For a balanced approach, the legendary Wall Street fund manager Peter Lynch would opt for Visa, V, at $285.15. He would see this as a high-quality growth and value hybrid that benefits from global spending patterns regardless of short-term volatility, providing a steady anchor for any portfolio. Visa's ability to maintain margins during inflationary periods makes it a robust choice for those seeking stability without sacrificing all growth potential. For those seeking growth, the world's leading innovative fund manager Cathie Wood would target Palantir, PLTR, at $24.10. She would argue that despite the macro noise, the fundamental shift toward AI-driven enterprise software is an unstoppable secular trend that will reward aggressive holders. While the volatility is high, the long-term trajectory of data analytics remains a core pillar of the next industrial revolution. Finally, for a low-cost or contrarian play, the legendary macro investor Stanley Druckenmiller would look at ExxonMobil XOM at $112.40. He would view the rise in oil to $92 as a powerful tailwind for energy giants, utilizing a contrarian lens to profit from the very inflation that is hurting the rest of the market. By owning the source of the inflation, an investor can effectively hedge their portfolio against rising energy costs. Subscribe to stay ahead of the markets every single day. We break down the data so you don't have to. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.